Good day, fellow investors. The new JPM Guide to Markets for the next quarter is out, and what a great time to have it published. As always, we'll go through what's the news and compare it with the fundamentals so that you get an idea of the real weights and what is just noise. We will discuss the market, the economy, the debt, inflation, and then try to incorporate all these factors into an investing risk and reward scenario. Let's immediately start with the S&P 500, and the P ratio as the market is down goes lower. However, yes, the forward P ratio goes lower, but we must now also expect adjustments into forward earnings. Earnings were expected to grow more than 50%, and I said it is impossible that we go from 200 in 2024 real earnings to 300 in 2026, and then even higher. I see now the new prognostics, 11, 14, 12% earnings. What crazy Wall Street projections. Now we will be happy if at the end of 2026 we are back to current earnings given the new tariffs and global trade impacts. So always too exuberant for Wall Street, and then high valuations. Of course, if you expect 50-60% earnings growth, then you are happy to pay a high valuation, and the total yield of the S&P 500 is still just around 3%. We'll see later it should be 6%. That's minus 50%. And then if we look at revenue exposure, all the companies there have global revenue exposure. So prosperity, everyone is getting rich, doing better on this global trade. And you can see here, especially tech has 56% of global exposure, materials, communication services. 40% of revenues are global for the S&P 500, 59% from the US, so it could be hit from a recession. I don't think that these numbers now can be reached at all, but I didn't think that those could be reached even before the tariffs announcement. Anyway, net profit margins are high, and countries can also retaliate, but increasing the taxes on the US domination on global tech and things like that. You never know what will happen in the future. However, exuberant projections are always too risky. Value, yes, is cheaper, but I have always a problem with the general notion of discussing what value is. Because we discussed the Dow company just a month ago, and I said, okay, 7% yields look like value, price to book value is low, so everyone will categorize it at value. And now I look at the stock from when we discussed it, it's even lower. Now the yield is not 7, now the yield is 9%. However, some can call it value, but we have to watch for dividend cuts, and I told you that in a real downturn, this is trading not a 10% free cash flow yield, but a 20% average free cash flow yield over cycle. You need dividend cuts, you need less investments, and then the plans putting on maintenance and care and things like that, and then you can wait for an upturn. And we are seeing that also in the valuations there. And I would not be surprised to see after the few great years we have had, like in the 1990s, I would not be surprised to see a 2000 to 2002 scenario going forward with 3-4 years of bad numbers. This is based on what we know now and what's coming. Things can always change, so we have to watch that. Let's discuss the economy. If we look at GDP growth, this is something very important that I always emphasize. GDP in the US is above trend. However, if you look at GDP, here you see that 19% of GDP is government spending. 19% is government spending, and the government needs to borrow 25% of what it's spending just to finance that. So if I take away 25% of what is spending too much, or just half of that, let's say I lower the deficits from 7% to 3% on a sustainable nominal path, let's say, then we need to take here for 2% of GDP, and then there is no growth. So US economic growth is based on deficits. If not, it would be equal like Japan, the Eurozone, UK, around 1%. So this is not exceptionalism, this is overspending on future borrowing on debt. That's how it is. And unemployment looks good, so of course, if you are having the economy grow, inflation, look at this, wage growth 4%. Whoa, that is still high. Thus, things are still going good. Unemployment in Europe is also doing okay. Spain has improved, Italy improving, Germany stable at natural unemployment levels. If we look at components of GDP growth, consumption is the key, and of course government debt and spending. The question is, how sustainable is all of this? And let's look at government finances. So let's start here. 1. Real GDP growth. The expectations are for great continuous growth ahead, for deficits ahead. So deficits, we can borrow into eternity and this will work forever. Now there has also been discussion how the tax cuts will be prolonged, which means that debt to GDP will skyrocket, deficits will skyrocket, especially if we have a recession and tariffs don't cover for the damage those are doing. Plus, we have inflation there, not really going down, and probably we'll see it higher, especially in March, as people rushed to buy things before tariffs. Eurozone inflation is already a little bit lower, which allows for lower interest rates. The plan is to go even below 2% if possible, and perhaps with tariffs things will get cheaper globally. So the European Union will be able to lower interest rates, something that the Fed might not be able to do, and the market has already been increasing the projections to higher for longer interest rates. The interest rate game is something that we have to wait and see. It's impossible to predict. What we can predict is that whenever there is a crisis or half of a crisis, the government will step in and print money, but at some point this will lead to this, like we have seen in the last few years, and then it's also questionable how efficient at some point it is. This was very efficient, this was already less efficient, this was even less efficient. But that's how things work, and we have seen this great period of low interest rates that is now changing with higher interest rates. And compare this to the S&P 500, the yield I told you at the beginning, and you can see here that treasuries are now giving 4%. Usually stocks would give a 2% premium, so you need a 6% yield from stocks. Now it's still around 3%, so still 50% to go for normality. The yield curve has been normalizing, and long term people are already requiring higher rates from the US government. However, higher rates on a huge global debt pile, that also creates an unsustainable global situation. On top of everything, the markets, especially the US market, is highly, richly priced, and every little shock like we have seen now sends the market down 5% in a day. International stocks have rebounded a little bit, but are still historically much cheaper than the US markets. Global valuation, emerging markets, China, Japan is a little bit better, Eurozone, I don't see this. So I have checked, and most expensive, good companies are very expensive in the Eurozone. So this might be banks, insurance, things like that, that are a big part, but that's too risky for me to look. So don't take this into account. Look for individual businesses. When it comes to global technology supply chains, only 25% of chips is made in Europe, in the US. The rest is made mostly in Asia and China, Taiwan. So that is also something to think about when it comes to global trade prices, AI developments, global mining production by location, rare earths, all in China. So all the things that you need for the tech and things like that. Look at this, nickel, Asia, what was it, Indonesia, things like that. And cobalt is Africa, zinc, we have North America, excluding US, and things like that. It will take a few years of adjustment for the new policies, if those policies don't change, but adjustments leads to uncertainty, uncertainty leads to less investments, leads to recessions, leads to slowdowns, leads to less prosperity, leads to pain, and that is the circle that has been now triggered. And if you look at investments from a high valuation point, you see that there is the risk of high and low over 1 year, over 5 year, 10-year rolling period. This is historical from 1950. And then over 20 years, you will likely make money because businesses grow and things. But there is a huge difference between 6, 11% and 18% per year. So the outlook is that the debt levels are unsustainable and the cost of that will start to bite, have already been starting to bite, but let's get a fight with the world, start talking about tariffs and shift the focus on that. So the key core message is always that. Second, valuations are high. So if it wouldn't be tariffs, it would be something else. There's nothing that we can make more important than debt and valuation. However, on the other hand, crashes, lower stock price can create opportunities if you have a long-term view as we have. We have said now we are 8 billion, 2050 there will be 10 billion people. So look at those long-term trends, long-term cash flows, long-term competitive advantages. We have discussed food, and then look at the right price where at that price, yes, it can go lower, but at that price, it is very, very uncertain that you lose money. Tomorrow, we'll discuss the 40 stocks we have discussed over the last quarter. So I'll see you tomorrow in the video.